Well, g'day folks. Well, they say a week is a long time in sport, but that can also apply to the economy and the property market. Now, typically when we hear a federal election is called, that tends to consume all of the media attention, particularly given there was a debate this week, if we didn't know, and also we're just weeks away from that decision. But that wasn't the case this week, and you guessed it, it was all about tariffs, trade wars, and a near bare share market capturing all of the media attention. But let's break it down because it seemed nowhere was safe. The ASX falling back to 2022 levels, seeing the largest single day fall since COVID and the GFC. Bond yields fell to a 2-year low. Now, the importance of this is that it does indicate monetary easing cycle could not be far away. We also saw almost $200 billion wiped off Aussie super funds. The volatility is absolutely wild. Overnight, Trump putting a 90-day hold or pause on most countries' tariffs. This sent the US share market soaring, and we'll see that unfold on the ASX today. But the China battle is only just heating up as Trump raised tariffs on Chinese imports from 104% to 125%. China, they've retaliated with an 84% tariff on US goods. Now, the CBA says strap in, with the chief economist, Luke Yemen, warning of a protracted trade war between the US and China, which most certainly appears to be on. And now the impact of all of this unfolding has been really evident through the property market this week, and it comes on the back of a market where we're already seeing and experiencing some buyer hesitation with real affordability constraints in play. It's also a really tricky time period looming. As we know, we've got Easter, we've got Anzac Day, and then we've got the federal election all back to back. And now on top of this absolutely wild share market swings and economic uncertainty. Already the Sydney auction clearance rate saw a sub 50% outcome last week, coming through at 48.3%. from big volumes, 1,403 auctions. But as mentioned, the haven and bond yields have fallen to a 2-year low on Wednesday as calls are growing for sharp rate cuts. Now, the headlines are thick and fast for a supersized 50 basis point rate cut when the RBA do meet in May, reducing the cash rate from 4.1 down to 3.85%. Also, an AFR poll found 29 out of 40 economists are forecasting a rate cut in May. But it gets really interesting though, with most banks and economists now forecasting 4 rate cuts this year compared to just 2 before tariffs were introduced. If this occurs, it could absolutely supercharge the property market. And if share market volatility continues, shell-shocked investors will move from a trickle to a flood back to property. Now, investor lending, as many people may know, is already increasing and growing at the fastest pace since 2022. Couple this with the real potential of a sharp and aggressive rate cutting cycle, and this feels eerily like COVID all over again. Now, legendary investor Ray Dalio is warning investors not to get too fixated on these tariffs. He believes there are far greater problems such as the US debt, China holding that US debt, but still hooked on selling goods to a borrower like the US. We've previously reported that Warren Buffett is holding $500 billion in cash as he quietly exited the share market last year. So what did he know? He's the only top 10 mogul whose net worth has risen through the course of this year. Now, the point being that outside of these tariffs and a trade war, shares were already overvalued and deeper underlying problems were evident. So now we have the pieces of the puzzle slowly falling into place to rocket the property market. We have volatile economic conditions, we have protracted trade wars, we have significant equity devaluations, weaker growth, and a falling Australian dollar. But then we see a lift in investor lending for residential property, and we are on amber alert for an aggressive rate cutting cycle. This feels like we did this dance sometime again, if I have to think, back in 2021. And when that happened, property prices jumped 15% in just 6 months. Now, no two markets are ever the same, we understand that, but the warning lights are certainly flashing brightly. Now, this should be a moment sensible people look to buy and sell, because when the market shifts, it happens in an instant. Now, not sure many people like to go back to that market when properties are sailing past reserves and they're competing with 5 or more buyers at every property. So we say, pay attention. Now, that's what's going down in and around the market this week. Thanks so much for watching, and we look forward to seeing you out and about.